And since this is a credit sales, accounts receivable increase debit. And on the other hand, our inventory decrease credit and expense increase, which is cost of goods sold debit. So should I need to repeat this credit and debit stuff one more time? I think I need to repeat that. Let's repeat. What happened when we have sales? Okay, let me make an example for you guys. Okay, we sold, first of all, we sold on cash. Sold on cash 1,000 and cost was 80,000. So what is the entry of the sales? Number one, cash sales, cash increase, sales increase. So cash increase, cash is an asset, asset increase debit. Entry would be from debit to credit. So here, cash to sales, 100,000. Second entry would be reduction in inventory because we sold. So this sales also include reduction in inventory, right? So inventory reduced worth of 80,000, and that inventory go to income statement and that is a balance sheet, in the balance sheet negative, and it is a plus sign in income statement. So inventory decrease credit, cost of goods sold debit 80,000. Right guys? So every sale occurred, it triggered two entries. Record the sales and record inventory. Now let's have the another example in which there is a credit sales. Now credit sales 100,000 and the cost was 80,000. So when there is a credit sales, sales increase. Credit sales mean our customer increases. So what is the entry then? You record the sales. Account receivable asset, our account receivable is our asset, asset increase debit. So account receivable, sale increase credit, right? So account receivables to sales, 100,000. Second entry would be to record the cost or decrease. So this cost would be negative from inventory, which is a balance sheet item, and the same cost is going to be added as a cost of goods sold, and this is an income statement item. So this expense increase, that is debit, asset decrease, that is credit. So cost of goods sold to inventory 80,000. Right? This is how we record our sales, credit sales and cash sales. Any question?
No.
Good guys, let's move forward. So if we see the key accounts, so inventory is going to be reduced because this much amount is sold, and that will decrease our inventory. Decrease in inventory is going to be on credit side. So here you see that it is decreased, and since we expense this amount, so we create another T account in which we make it as an expense, and expense increase debit, so it is on the debit side. Right, guys? So, and how they are going to be treated on income statement, the cost of goods sold is right after sales revenue minus cost of goods sold. Answer is gross profit. And in balance sheet, it is written as after cash, short-term investment, and accounts receivable, it is inventory. Inventory left 180,000. So now let's talk about this. The cost of inventory. Like in our example, I told you the cost is 80,000. So where this 80,000 came from, right? So similarly, for example, we purchased the inventory 600,000, right? And now the freight in, which means the cost of transportation from seller to buyer. So in that case, we are the buyer. So it costs us 4,000 to pay transportation costs. Freight in, not out. Freight out is that we are paying for customer. Freight in is like we are paying for ourselves. We purchase some inventory and we are paying the cost of purchases, right? So we are increasing our inventory and we are paying the transportation cost. So we call this freight in. So we would add the freight in, some purchase return, that some goods that are arrived at our doorstep, we don't like them or it's not according to our specification, we return that. The 25,000 worth of goods we return, so we less it. And the allowances, purchase allowances, we purchase in bulk, so we need some kind of discount. Discount is also less, right? So allowances and discounts are also less. So this is called the net purchase of inventory, right? So this 80,000 or this 560,000 include all the purchase return, purchase allowance, all the transportation paid by us, not by the seller. If by the seller, then we don't include it here. Understand? So the net purchases, or when we, when we talk about the business purchase goods worth of 80,000, it means the background calculations are like this. Unless the question specifically mentioned that the customer or purchased 80,000 worth of goods from supplier, the company purchased 80,000 worth of goods from supplier and paid 10,000 freight in and returned 5,000 worth of goods. So in that case, the total purchase is going to be 85,000. Right, guys? Now let's talk about the inventory illustration here. So the general entry to record purchase return of merchandise of cost 500 is going to be here. Similarly, right? Purchase return. It means when we purchase, that entry would be purchases, which is inventory. Purchases is not any account, is an inventory account. Inventory to account payable. So when we return the goods, it means we need to reverse this entry. It's going to be accounts payable to, and it makes sense as well because 500 worth of goods is going to be decreased from our inventory stock. So inventory decrease, credit, and we are not liable to pay 500 to our suppliers, so liability decrease, debit. This also makes sense, right? So whenever we have a purchase return, entry would be account payable to inventory, the reverse entry over of purchases from supplier. So the journal entry of purchases of 1,000 goods in merchandise is going to be, can you make this entry? You purchase worth of 1,000. Question is silent about whether this is cash purchase. So make it as it is a credit purchase. So what would be the entry? Junpyo?
1,000 from
What is the entry?
mm,
You purchase goods.
sales.
Purchase goods. Buddy, this is not the sales. You
Oh,
purchase goods.
inventory.
Mm-hmm.
Debit in 1,000.
What two accounts are going to be disturbed in this purchase? You told one is inventory, yes. The other,
Cash.
this is not the cash sale, this is credit purchase. Not the cash purchase, this is credit
Account
purchase,
payable in credit.
right?
Yeah.
So inventory increase, our liability also increase. So what is the entry here? Inventory to accounts payable, right? Right, Junpyo?
Yes.
Okay. Now, the allowances or the discounts, how we are going to account for. So recall our discussion, what does it mean by 210 net 30? So let me read this illustration here.